What if I told you there's a massive loophole that can save you $20,000 to $100,000 if you're pursuing student loan forgiveness? Well, the good news is there is. And in this video, I'm going to show you exactly what that loophole is. And I'm going to show you one common mistake borrowers make that costs them thousands of dollars. With that being said, let's jump into it. First things first, I hate watching videos on YouTube just to find out at the very end it doesn't pertain to me. So in this video, who am I talking to? It is for people that are on loan forgiveness, so IBR, pay as you earn, public service loan forgiveness, and that are married. And even if you're not married and you might be getting married in the future, then this also pertains to you. Now, let's get into this loophole, and then we'll get to the mistake that people make after that. So the first thing I want to say about this loophole is you got taxes and you got student loans. Two confusing topics, right? Therefore, if you guys have any questions about this or you're confused about any of it, be sure to put it down in the comments. I'll be sure to answer those so that way you can get answers to your questions. So when you're on an income-driven repayment plan, your payments are based as a percentage of your income. When you're married, that could be based on you and your spouse's income or just your income, depending on how you file your taxes, jointly or separately. Filing jointly can mean significantly higher payments. So for example, let's just say you make $80,000 a year and your spouse makes $90,000 a year and doesn't have any federal student loan. Your monthly required payment would be $1,235 a month. Now, if you filed separately, then your monthly payment would be about $480 a month. So it's about a $750 difference in this example, and that's per month. Now you do that over 20 years, that's $180,000 you would save by filing separately. But what if you could keep your student loan monthly payment low and pay less in taxes? So that way you don't have to make this decision anymore. Wouldn't that make your life a lot less stressful and oh, by the way, put a lot of money back in your pocket? Where there is a way, and that's where the tax loophole comes in. So here's how the strategy works. You file your taxes married, filing separately. So in the current year, your required student loan payment drops. Then in future years, you amend your previous year's tax returns back to jointly and get a tax refund. This approach allows you to get your lower student loan payment today and get a refund in the future. So let's illustrate this with an example. Earlier, I gave you an example where the couple saved $750 per month by filing separately and getting a lower student loan monthly payment. However, because they filed separately, it would cost them $4,000 in taxes. So step one is to file separately in 2024 to save $750 per month. Step two is to file separately again for the tax year 2025 and get a lower student loan payment again. Then in 2026, for that tax year, they file separately, getting another student loan payment that's lower. But in 2026, they go back and amend their 2024 tax return back to jointly and get a $4,000 tax refund. And then the last step, you just keep repeating that every year until your loans are forgiven. And for this couple, doing that over a span of 20 years will give them an estimated $80,000 more in their pockets. However, some of you had started filing separately years ago in order to have lower required monthly payments. So currently, you can go back to 2022 and amend that tax return back to jointly and get a tax refund. Now, I mentioned at the beginning of this video that in addition to this loophole, I'm going to share with you a mistake that people make. Before getting into that mistake, I wanted to let you know that this tax loophole is so big that we have started developing a software that would allow you to easily figure out if you can save by amending your documents. And if you can, with just a few clicks of a button, you can actually amend it and then send it to the IRS and have that money delivered straight to your bank account. This software that we're building should be ready by the second half of 2025. Now, if you're interested in using that software to make this process easy, we've opened up a no obligation waitlist, and I'll put a link to that in the description as well as the pinned comment to this video. Now, the number one mistake we see couples make when they're on an income-driven repayment plan is contributing to a Roth IRA. When you file separately, you cannot contribute directly to a Roth IRA. You have to do what's called a backdoor Roth IRA. Now that is a video in and of itself. So the next thing for you to do is